Warren Buffett shares his thoughts on the challenges and risks associated with short selling in the stock market. Buffett highlights the significant differences between being short a stock with unlimited potential losses and being long a stock that has already been paid for. He explains that while overvalued stocks are more common than undervalued ones, short selling is a tough business due to the potential for unlimited losses and the presence of promoters and crooks in the market.
Being short something where your loss is unlimited is quite different than being long something that you've already paid for. And it's tempting. You see way more stocks that are dramatically overvalued in your career than you will see stocks that are dramatically undervalued. I mean, it's the nature of securities markets to occasionally promote various things to the sky, so that securities will frequently sell for 5 or 10 times what they're worth, and they will very, very seldom sell for 20% or 10% of what they're worth. So therefore, you see these much greater discrepancies between price and value and on the overvaluation side. So you might think it's easier to make money on short selling. And all I can say is it hasn't been for me. I don't think it's been for Charlie. It is a very, very tough business because of the fact that you face unlimited losses, and because of the fact that people that have overvalued stocks, very overvalued stocks, are frequently on some scale between promoter and crook, and that's why they get there. And once they're and they also know how to use that very valuation to bootstrap value into the business, because if you have a stock that's selling at 100 that's worth 10, obviously it's to your interest to go out and issue a whole lot of shares, and if you do that, when you get all through, the value can be 50. In fact, there's a lot of chain letter type stock promotions that are sort of based on the implicit assumption that the management will keep doing that. And if they do it once and build it to 50 by issuing a lot of shares at 100 when it's worth 10, now the value is 50, and people say, well, these guys are so good at that, let's pay 200 for it or 300, and then they can do it again, and so on.
Short selling presents significant challenges due to unlimited potential losses and the prevalence of overvalued stocks. Warren Buffett and Charlie Munger have found it to be a tough business. Overvalued stocks often involve questionable practices, ranging from promotion to fraud. Some businesses manipulate their stock value by issuing shares, leading to inflated prices. This creates a cycle where investors continue to pay higher prices based on the assumption that such practices will persist.
It's not usually quite that clear in their minds, but that's the basic principle underlying a lot of stock promotions. And if you get caught up in one of those that is successful, you can run out of money before the promoter runs out of ideas. In the end, they almost always work. I mean, I would say that of the things that we have felt like shorting over the years, the batting average is very high in terms of eventual. They would work out very well eventually if you held them through. But it is very painful, and it's in my experience, it's a whole lot easier to make money on the long side. I had one situation, actually an arbitrage situation, when I when I moved to New York in 1954, so it was about June or July of 1954. That involved a surefire type transaction, an arbitrage transaction. It had to work. But there was a technical wrinkle in it, and I was short something. And I felt like for a short period of time, I felt like Fanova was feeling last fall. I mean, it was very unpleasant. You can't make, in my view, you can't make really big money doing it, because you can't expose yourself to the loss that would be there if you did do it on a big scale. And Charlie, how about you?
Well, Ben Franklin said if you want to be miserable, during Easter or something like that, he says borrow a lot of money to be repaid at Lent or something to that effect. And similarly, being short something which keeps going up because somebody is promoting it in a half crooked way and you keep losing and they call on you for more margin, it just isn't worth it to have that much irritation in your life. It isn't that hard to make money somewhere else with less irritation.
It would never work on a Berkshire scale anyway. I mean, you could never do it for the kind of money that would be necessary to do it with in order to have a real effect on Berkshire's overall value. So it's not something we think about.
Warren Buffett and his partner Charlie Munger believe that short selling is a challenging strategy, primarily due to the risk of unlimited losses and the presence of manipulative practices in overvalued stocks. Buffett emphasizes that although short selling may appear tempting, it has not been a successful approach for him personally. Instead, he finds it easier to make money on the long side, focusing on identifying undervalued stocks. Buffett and Munger conclude that short selling on a large scale would not align with the investment philosophy of Berkshire Hathaway and suggest that investors seek alternative strategies with less irritation and greater potential for success.